to make a target profit. So the sales to be made either in shillings or basically in units for the company to be able to make what? This is a very quick recap on what you have said is that a deferred tax basically is a tax which the company was supposed to pay during the current year. That tax has been deferred, it will be paid in the future, or it is a tax refund the company was supposed to get during the current year that has been deferred. The company will be refunded that tax in the future. Now, we have therefore two types of deferred taxes: the deferred tax liability, deferred tax asset. So a deferred tax liability basically have said that this is a tax which is payable by the company in the future. We recognize that as an non-current liability in the statement of financial position. Deferred tax asset is a tax to be recovered by the company in the future. This one is recognized as a non-current asset. Now, on the other hand, we have said a deferred tax basically arises as a result of the difference between the accounting profit and the taxable profit. If these two profits are different, the accounting profit and taxable profit, that give rise to deferred tax. And basically, I've said the taxable profit is a profit which is computed by the company based on the existing tax laws. The accounting profit, this is a profit which is computed using the accounting standards and also the various accounting policies adopted by the company. Accounting policies include things like the methods of depreciation, how is the company depreciating its assets, and so on. So therefore, if these two profits are different, basically we are saying that will give rise to deferred tax. And basically what we were looking on this small illustration here, we have said that we assume the taxable profit of the company is 30 million. The accounting profit or the profit before tax is 40 million. The tax rate applicable to this company is 30%. And then what you're required to do is we compute the deferred tax. Now, we have said that for us to be able to compute the deferred tax, the first thing we need to do is to determine the tax which was supposed to be paid during the current year. The tax which was supposed to be paid by our company should be 30% of its profit. And basically, in this case, I've said, when we talk about profit generally, we are referring to the accounting profit. The accounting profit in this case is how much? 40 million. So the profit, the tax which was supposed to be paid will be 30% of the profit, which is basically 40 million. That will give us 12 million. But now we then need to ask ourselves, is this the actual tax to be paid by our company? Is this the actual tax to be paid by our company? Automatically, no. Because you can see we have the taxable profit. In other terms, this taxable profit is different from this. So therefore, the actual tax to be paid by our company here will be 30% of the taxable profit. The taxable profit is what? Is 30 million. And that basically will give us what? Will give us 9 million. Now, the difference between these two figures there, the tax the company was supposed to pay and the actual amount of tax to be paid by our company here, that is 3 million. 3 million, we refer to this as a deferred tax. We refer to that as what? As a deferred tax. Deferred tax, why? This, you can see during the current year, the year 2024, our company was supposed to pay a tax of 12 million. But the actual tax to be paid would be 9 million. This one being the accounting profit and taxable profit are different. It basically means that during the current year, the company has paid less tax than what it was supposed to pay. Now, this one will be known as a deferred tax liability. Will be known as a deferred tax what? Liability. Will be known as a deferred tax what? Liability. The tax the company was supposed to pay during the current year, but because the taxable profit is less than the accounting profit, this tax has been deferred, and basically it will be paid in the future. Now, as an accountant, the moment you are preparing the income statement, what you need to do, the moment you have to prepare the income statement here, the income statement, you should always start with the profit, or actually, once you have this profit before tax, like in our case, the profit before tax is 40 million. So to this, you come and you less the current tax. The current tax is the actual tax to be paid. The actual tax to be paid, this is basically what you refer as the current tax, and that is 9 million here, 9 million, 9 million. Also, you can see during the current year, our company has paid less tax with 3 million. Now, what you need to do as an accountant, in accordance with something called the prudence concept, you need to set aside 3 million from the profit of the current year to be used in terms of paying these taxes, tax in the future. That is in accordance with the prudence concept. Remember what prudence concept requires, that if you expect a loss to be, if you expect to incur loss in the future, you need to provide for it today. You need to provide for it what? Today. So we make a provision for 3 million. To make a provision basically means that from this profit, we will set aside 3 million to pay the tax which the company was supposed to pay during the current year, but it has been deferred. It will be paid in the future. So basically, this one we refer to it as a deferred tax what? Expense. A deferred tax what? Expense. So that is not necessarily the tax which has been paid, but basically what we are doing, we are creating a provision. We are creating a provision. We know what is a provision. A provision, even from your salary, is where you set money aside to do something, to undertake a project you want to do what? To undertake in the future, or you want to implement in the future. So therefore, this is not a tax which was necessarily paid, but the reason why we are deducting that from the profit is purely to do what? To create a provision, to set aside 3 million to be used in terms of paying the taxes which are expected to be paid in what? In the future. In what? In the future. Now, in this case, or basically this difference between the accounting profit and taxable profit, that difference, the difference between the accounting profit and taxable profit, can actually be classified into two main categories. We have something called the permanent difference, and then number two, we have something called the timing difference. The timing what? Difference. So what do you mean by the timing difference and the permanent difference? Which we are saying is that difference between accounting profit and taxable profit. Now, first of all, we talk about the permanent difference. This is actually the difference between these two profits. The difference between accounting profit and taxable profit. And what causes this difference? This difference is basically occasioned or basically caused by taking into account certain items of incomes and expenses in the computation of this profit, in the computation of accounting profit, but those items are not taken into account in the computation of taxable profit. In the computation of taxable what? A profit. In the computation of taxable what? A profit. So this one is caused by taking into account certain items of incomes and expenses, items of incomes and expenses, items of incomes and expenses only in the computation of the taxable what? A taxable profit, but those items are not taken into account in the computation of taxable profit. And automatically you know which are these items. Which are these items of incomes and expenses? These items are non-taxable incomes and disallowable expenses or non-deductible expenses. For example, what we know in computing the accounting profit, we may take into account expenses such as penalties, fines, amortization of assets. So all these are expenses, penalty, fines, and amortization. So we take into account all those particular expenses in the computation of accounting profit. But basically what we know in taxation is that those expenses are non-deductible or they are disallowable expenses. That's basically what we know. In computation of the taxable profit, you don't, or basically those items are not taken into account. We don't take into account penalties, fines, and amortization of assets, including impairment loss on goodwill. So automatically, that will give rise to a difference between, or make the accounting profit and taxable profit to be different. And that difference is known as what? The permanent difference. The permanent what? Difference. Now, we say that this difference basically does not give rise to deferred tax. And therefore, in the computation of deferred tax, this difference is what? Is ignored. This difference is what? Is ignored. So the question you may come across in addition to that in an examination setup is just whereby you're required to explain what is permanent difference. Sasa? Yes. Now, on the other hand, when we talk about the timing difference, this is the difference which is occasioned by taking into account items of incomes and expenses, items of incomes and expenses in the computation of two profits, the accounting profit and taxable profit, but in different accounting period. But in what? Different accounting period. Different accounting what? Period. Different accounting period. For example, in this case, you may be told that a company incurred a certain expense in the year 2024, and this expense will be taken into account or will be used in the computation of accounting profit, maybe during the year 2024. But this expense will only be treated as allowable expense, maybe in the year 2026. So meaning that this expense will be used in the computation of the true profit, but in different accounting period. In computing the accounting profit, it will be considered in the year 2024. In computing the taxable profit, it will be considered in which year? 2026. Now, this is basically the difference which gives rise to deferred tax. Is the difference which gives rise to the deferred what? To the deferred tax. So the timing difference basically is the difference which gives rise to what? Is the difference which gives rise to the deferred what? Which gives rise to the deferred tax. Give rise to deferred tax. As Anne is asking what? Assuming practically the company has excess what? Excess refund claim from KRA. Is the deferred tax asset? Is this a deferred tax asset? Is this a deferred tax asset? It all depends. Basically, if a company has a tax refund claim, so the company is claiming a tax refund. A tax refund claim is usually an asset. Is usually what? An asset. That is the first thing. But if, for example, you expect to recover this, or maybe you automatically, does KRA refund? Yes, maybe if you have the necessary documents, you can refund. But in most of the cases, you offset that maybe against the future what? Taxes. So usually we treat that as a deferred tax asset in case that amount of money is expected to be refunded beyond, for a period beyond 1 year. For a period beyond what? Beyond 1 year. But essentially, a claim for a tax refund is usually an asset. Is usually what? An asset. That's that? Yes. Now, in this case, I want us to look on some few terms. Basically, we're going to come across in the computation of deferred tax. We look on some few terms here. Definition of terms. These are also terms you may be required to define in an examination setup. Definition of terms. So the first term here is something called the carrying amount, abbreviated as CA, carrying amount. So what is CA? So this is the value of asset or liability in the statement of financial position. So that particular value at which an asset or liability is recorded in the statement of financial position, we refer to it as the carrying amount. We refer to that as what? Carrying amount. For example, we know that items of PP are recorded here at their net book value. So the value at which an asset or liability will be recorded in the statement of financial position is the carrying amount. Number two, we have the tax base. Tax base basically is the value of an asset or liability for tax purpose. For tax purpose. For tax what? Purpose. Let me give a good example of maybe an asset which qualify for investment deduction, or for an asset which qualify for what? For investment allowances. This is something you did in PFT. There are those assets which qualify for capital allowances. Now, if you happen, for example, to own such an asset which qualify for investment or capital allowances, and basically you sell that asset. You sell what? You sell that asset. For you to be able to determine the amount which you're going to treat as a taxable income, or the amount which you're going to treat as deductible expense, you take the sales profit minus the written down value. Minus the written down what? Written down value. There is a name, I think, which was given to this in taxation. I think trading, are they called trading receipt? Yes, something like that. So the difference between the sales profit and the written down value. So that amount is the one which is allowable or deductible in taxation. So therefore, in computing that amount which will be allowable or deductible in taxation, what do we consider as far as this asset is concerned? The written down value. So therefore, tax base is the value of an asset or liability for tax purpose. So the other term is temporary difference. Temporary difference. Now, temporary difference abbreviated as TD, this is the difference. This is the difference between these two values, the difference between carrying amount and tax base. Carrying amount and what? And tax base. So in other terms, to compute the temporary difference, we take the carrying amount minus the tax base, of which in this case, we can either get a positive figure here, or we can get a negative figure. So if we get a positive figure, that one is called taxable temporary difference. If we get a negative figure, that one is called deductible temporary difference. So therefore, in that case, we can say we have two types of temporary differences. We have the taxable temporary difference. Actually, this one is abbreviated as TTD. Just understand, remember those abbreviations. TTD, taxable temporary difference, whereas this one is called the deductible temporary difference. Deductible temporary difference. So therefore, here we have two types. Types of temporary difference are two. We have the taxable temporary difference, and number two, we have deductible temporary difference. Now, a taxable temporary difference, we say is a temporary difference which gives rise to amount which are taxable in the future. So this give rise to amount taxable in the future. Amount taxable in what? In the future. And because it gives rise to amount which are taxable in the future, we can also say that this will give rise to, or it results to, something called a deferred tax liability. So we can say this gives rise to deferred tax liability. Deferred tax liability. This gives rise to the deferred what? The deferred tax liability. Remember from our introduction here, we said deferred tax liability is a tax payable in the future. Why do we have a tax payable in the future? Because the taxable temporary difference will give rise to amount which will be taxed in the future, which are taxed in what? In the future. So therefore, the TTD, taxable temporary difference, give rise to deferred tax liability. Now, a deductible temporary difference. Deductible temporary difference, this give rise to amount which will be allowable in the future. So this one give rise to amount which are allowable or deductible in the future. The amount which are deductible or allowable in what? In the future. In other terms, you can say that this give rise to a deferred tax asset. This will give rise to a deferred tax what? Deferred tax asset. I will try to simplify this because I don't want to go into details. So just understand what Morimo is teaching you here, that in case we have a taxable temporary difference, that give rise to deferred tax liability. That's just what you need to know. No need of going into details as to why that will occur. The deductible temporary difference, this give rise to a deferred tax what? Asset. Sasa. And also you need to remember here, we have those two types of temporary what? Difference. We have those two types of temporary difference. Now, the other term we can maybe define here. The other term we can also define here. Number 4, that is term number 3. Number 4, we have basically what you have already mentioned here. Deferred tax liability. Deferred tax liability. And from my introduction, you've already said that these are tax payable by the company in the future as a result of taxable temporary difference. Tax payable in the future. Tax payable in the future. In the future as a result of taxable temporary difference. As a result of what? Taxable temporary difference. So therefore, how do we compute this one? How do we compute the deferred tax liability? This is basically one of the formula you need to remember. How do we compute the deferred tax liability? We take the taxable temporary difference. The taxable temporary difference, we basically multiply that with the tax rate. We multiply that with what? With tax rate. That formula you need to remember. That is one of the formula we're going to apply. The other term, the last term you need to know how to define here is the deferred tax asset. Deferred tax what? Asset. So deferred tax what? Asset. Now a deferred tax asset, basically, this is a tax which is recoverable in the future as a result of deductible temporary difference. So a tax which is recoverable in the future as a result of deductible temporary difference. As a result of deductible temporary what? Difference. As a result of deductible what? Temporary difference. So therefore, to compute the deferred tax asset, so this is the formula which we use. We take the deductible temporary difference. We multiply this with the tax rate. We multiply that with what? With the tax rate. We multiply that with what? With the tax rate. There is also something you need to recall from something I've explained here, that this one, that is the taxable temporary difference. The taxable temporary difference, remember what I've explained here. I've said that taxable temporary difference, this one arises whereby the carrying amount, this is very important, the carrying amount of either an asset or liability, this one exceeds the tax base. This one exceeds what? The tax base. So if you're given the carrying amount, you're given the tax base of the company's net asset, you get the difference, and actually you compare the two values, and the carrying amount happens to be more than the tax base, the difference is known as taxable temporary difference. But in this case, the deductible temporary difference, this one arises whereby the carrying amount is less than tax base. Is less than what? Is less than tax base. So if the carrying amount is less than tax base, the difference between the two values, carrying amount and tax base, is known as deductible temporary difference. And actually we use that deductible temporary difference to do what? To compute the deferred tax asset. So I think, first of all, those are some of the terms you must be in a position to define. You may come across a question whereby you are required to define any of those particular two terms. You'll be able to see, I think there was a question some time back, which was requiring the candidate to differentiate between temporary difference and timing. Was it temporary difference and permanent difference? Permanent difference and the timing what? Difference. We'll check on that question. Then from there, once we proceed and basically look on the approaches used in computation of deferred tax. Approaches used in the computation of deferred what? Deferred tax. If a company is computing the deferred tax, either the deferred tax asset or the deferred tax liability, which approaches can be used? Here we have two approaches which the company can use. Number one, we have the income statement approach. Income statement approach. Now, under this particular approach here, the deferred tax is basically computed using the difference between the taxable profit and the accounting profit. So here we can say the deferred tax is computed using the difference between accounting profit and what? And taxable profit. And I hope you can be able to recall this difference between accounting profit and taxable profit, we have said is broadly classified into two: the timing difference and the permanent difference. But in this case, we have said that the permanent difference is ignored for the purpose of computing the deferred tax. So therefore, the difference which is considered here is the timing difference. In other terms, we can say that under this approach, we compute the deferred tax using the timing difference. We compute the deferred tax using the timing difference. Now, this particular method here is not recommended by this standard. So we can say IAS 12 does not recommend the use of this method, does not recommend use of this what method. For example, if you check on the questions which are tested nowadays, they always require you to use the other method, the other approach. So there is no question will come across. Maybe some questions which were tested some time back, the candidates were required to use this method, but questions which are tested nowadays, they require the candidate to use the other approach. So this method here is not recommended for use by the International Accounting Standard number 12. So we have the last approach here, or the last method, which is known as number 2, the statement of financial position. In other terms, is also called the balance sheet approach. The balance sheet approach. Now, under this method here, we compute the deferred tax using the permanent difference. What is permanent difference? The difference between carrying amount of tax base of various items of asset and liability. So we can say here the deferred tax is computed using the temporary difference. Temporary difference is the difference between the carrying amount and the tax base of various items of asset and liability. So here we compute the deferred tax using the temporary difference, which is the difference between the carrying amount and tax base of asset and liabilities. And basically, this is the recommended approach. So we can say this is the recommended approach by IAS 12. The International Accounting Standard number 12 basically recommend the use of this method. And I've said, if you check on all the past papers, the recent past papers, you'll be able to see that all questions coming from this, they usually require a computation of deferred tax using using this method here, using the balance sheet method, or basically the statement of financial position approach. I think basically that's what you need to know. Maybe the other concepts you need to understand, maybe I'll be able to explain more on that as we do an illustration. An illustration. Therefore, we will first of all take a short break. As we come back, there is a question I want us to do, a question similar to maybe a question there was a question which was in a file, and I think it was actually borrowed from the paper for AFR. That is a question I want us to start with, a question which was examined some time back, not too back. That is let me see the question here. Yes, so this is which sitting is this? November 2019, that is the question we are going to start with. Not actually, I'm saying these are questions which you came across in a PAL, CP intermediate level, because I think it was tested there. So November 2019, which is the question number what? Question number number 5B. Question 5B. Question 5B. So we take a short break, 5 minutes or 10 minutes. We take a short break of 5 or 10 minutes. Yes, a break of 5 or 10 minutes. Yes, 10. We take a break of 10 minutes. We come back. Make sure you have that question with you. And then we do it maybe within the next 30 minutes, we'll be done. So see you after that short break. Yes, we continue. I hope you're back. Let's continue. Let's continue. Let's continue. Let's continue. Let's continue. Yes. So what are we told as far as that question is concerned? I hope you already have the question with you. Yes. Do you have the question? Abdul Nasir, Mark, do you have the question with you? And Daniel, Douglas, do you have the question? Fred, Ismail, Reese, Mercy, Patrice, Phoebe, yes. Okay. So what are we told in this question here? That is question number 5B. So the question reads, Mafuta Limited has a deferred tax liability as at 1st of October 2018 of shillings 400 million. For the purpose of preparing financial statement for the year which ended 30th of September 2019, the following additional information is available. So basically we have number one, you told the company is available for sale financial assets with a carrying amount of 80 million and financial asset at fair value through profit and loss of 40 million. Both financial assets reported losses in fair value of 8 million each as at 30th September 2019. Number two, inventory is shown. Inventory is shown at the road of the cost and the net realizable value. The cost is that 200 million, while the net realizable value is that 120 million. Number three, can someone share that question in the class WhatsApp group? Someone to share that question. Orangi, make sure you have those past papers with you. Make sure you have those past papers with you. Yes, number three, we are told receivables had a carrying amount of 2,000 million after making allowance for doubtful debt of 80 million and an exchange gain of 60 million, which is not yet realized. Both allowances and exchange gain are not allowed for tax purpose. Number four, trade and other payables are stated that is 600 million after making provision for discount of 40 million. Five, a property, plant and equipment has a carrying amount of 4,800 million and a tax base of 4,000 million. Some rented buildings were revalued upward by 200 million during the year, which ended 30th of September 2019. Four, that is number six, not note number four. We are told intangible assets consisting of trade licenses being amortized over 5 years had a carrying amount of 240 million. And this was allowable for tax purpose in full 2 years ago. So number seven, income tax rate 30%. So what are we required to do in Roman 2? Or actually in Roman 1 of the question, we compute the relevant temporary differences, 8 months, and Roman 2, we make the necessary journal entries to record the changes in the deferred tax liability. So we start with the Roman 1 there, whereby we are required to compute the relevant temporary differences, or basically the relevant TD, temporary difference. So in this case, what you just need to recall is what is temporary difference. In other terms, you just need to remember how do we compute this temporary difference. From our discussion, we have said temporary difference, this is equal to the carrying amount of an asset or liability minus the tax base. Minus what? The tax base. So basically what we need to do is we go through the information we are given in note number 1 all the way to note number 6. We are given a number of items of assets and liabilities. We will identify, we will determine the carrying amount of the tax base. and then we get the difference, which is temporary difference. Also, we have to recall we have two types of temporary difference, which is taxable and deductible. So what we need to do here is to have assets stroke liabilities. A column for assets stroke liabilities we're given from note 1 all the way to note number 6. Then we will have a column here for carrying amount. Carrying amount. Then we have the next column, which will be for tax base. And the difference between these two will be the temporary difference. Difference. And then if we check on the values which are given there, our values are in million of shillings. So that means that we will also work with our figures in million of shillings. We work with all our figures in million of shillings like that. We work with all our figures in million of shillings. So let's start with what you're given in note number 1. Let's go to note number 1. In note number 1, what are we told? I hope you're back in note number 1. Let's go to note number 1. So in note number 1, we are told that the company has got available for sale financial asset with a carrying amount of 80 million and financial asset at fair value through profit and loss of 40 million. Both financial asset reported losses, of 8 million each during the current year. During the current year. So in relation to, or in that note number 1, we are given financial asset. I hope you can be able to recall in the topic of financial instrument, we said financial asset is basically investment in equity instrument or investment in debt instrument. And actually, we talked about 3 types of, or 3 categories of financial asset. Financial asset at fair value through profit and loss. Financial asset at fair value through other comprehensive income, and financial asset at amortized cost. Sasa, yes, but if you check in our questions here, basically we have 2 financial assets. The first one is called available for sale. Now, if you can be able to recall another topic of financial instrument, we never came across something like this, financial asset available for sale. But this was a name which was used at this standard, International Accounting Standard number 39. And I hope you can be able to recall I mentioned something to do with this standard, International Accounting Standard number 39. We say this standard was superseded. In other terms, it was scrapped and replaced by IFRS 9. So currently, these financial assets are the ones we refer to as the financial asset at fair value through other comprehensive incomes. So that is the current name for this financial asset. Equally in the same point, we have the financial asset at fair value through profit and loss. Now we have their carrying amount. So the carrying amount for the first one, this one, is 80 million. And the carrying amount for the other one is, for this financial asset at fair value through profit and loss, is what? Is basically what? 40 million. So I'll give you some points which are important, maybe, which you can also use in answering other questions here as we move. I'll give you some few notes here just to guide you in terms of knowing the carrying amount, the tax base of various items of asset and liability. So I'll give some notes here. So the first one I'll give in relation to this financial asset. So financial asset at fair value through profit and loss, and also financial asset at fair value through other comprehensive income. Now, the carrying amount for this asset is always equal to the fair value. This is something we know from that topic of financial instrument, that these 2 financial assets are supposed to be recorded in the company's balance sheet, in the company's statement of financial position at their fair value. Their fair value is the carrying amount. Is the carrying what? Amount. What about the tax base? Their tax base is always equal to the cost. How much amount was incurred by the company in acquiring this financial asset? Sasa, that's what you just need to remember. Carrying amount, fair value, tax base is the cost. Now, what basically we are told is that these are the fair values. In that point, basically the last sentence of note 1, we are told both financial assets reported losses in fair value of 8 million. In other terms, their fair value reduced. So it basically means that if, for example, this is the fair value at the end of the, or actually this being the fair value at the end of the year, it was not acquired by the company at this amount. Because remember, we say that whenever the company is acquiring this financial asset, these shares, the company acquire them, buy them at their fair value, at their current market price. But you're told the current market price for this reduced with 8 million. Can you be able now to determine the cost at which they were bought? If their market value reduced with 8 million, can you be able to determine the cost which was incurred by the company in acquiring them? Automatically, yes. Can you be able to do that? Ida, can you be able to get to know the cost which was incurred by the company in acquiring those financial assets? Yes, we can be able to get the cost, because if their market value reduced with 8 million, automatically they were acquired at a value which is higher than this. So what we need to do to get the cost, which is the tax base, we will add 8 million here. 8 million, and also the same case here, 8 million. Sasa, yes, that will give us the cost, because their market value reduced with 8 million. So then we get the temporary difference, which will be, we are using this formula, this minus that. So this minus that, and I hope you can see that will give us -8. This minus that, which will give us -8. And basically what you have said is that if this happens to, or if this happens to be less than this one is called deductible temporary difference. In other terms, if you take this minus that and you get a negative figure, is the deductible temporary difference. The same case, that is a deductible temporary difference. But if you get a positive figure, is a taxable temporary difference. Let's move to point number 2. In point number 2, we're given something to do with the inventory. Even before you go through that point, I can also give you a note here in relation to the inventory. Inventory, we know that these are the assets which are held for sale in the ordinary course of business. So the carrying amount, this one is basically the lower of cost and net realizable value. And basically this is in accordance with the International Accounting Standard number 2. So we value the inventory. We record the inventory in the statement of financial position at the rate of the cost and the net realizable value. But what is the tax base? What do we take into account in taxation as far as the inventory is concerned? So the tax base, the amount of inventory for tax purpose is basically the cost, because basically what we know, the reason why a company will be having some inventory at the end of the day is because there were some purchases which were made. So we know purchases in taxation, they are deductible, they are allowable what? Expenses at cost. At what? At cost. So the tax base of inventory is what? Is cost. The carrying amount is the rate of those two values. So here we need to have the inventory. So the inventory, basically, we are told in note number 2, is shown at the rate of the cost and net realizable value, shown where? In the balance sheet, in the statement of financial position. The cost is 32. Net realizable value is 31.20. So we take the figure which is lower, which is basically 31.20. That is the carrying amount. That's what you have said there. But the tax base is the cost. The cost is 32. Is 32. So we equally get the difference. So you just, in addition to this, just remember that point. No need of cramming anything. Just remember that point which I've given you there. So what is the difference here? The difference between these two, is it 80 million? Yes, 80 million, which is basically a negative. And that is a deductible temporary difference. So we move to point 3, sorry. Point 3, we are given something to do with the receivables. I'll also give a note. Receivables, and also this applies to payables. So the carrying amount, this one is always the net amount. The net amount. What do you mean by the net amount? For example, the net salary. Net salary is basically your salary after all statutory deductions have been deducted. Deducted. The net amount you get. So receivables and payables are recorded in the statement of financial position at the net amount. For example, you know, receivables, we have to eliminate something called the what? The expected credit losses. Expected credit losses, these are basically the losses which are expected to be incurred in what? In the future. So therefore, the carrying amount is basically the net amount, but the tax base, this one is equal to the gross amount. The gross what? Amount. The gross amount, the original amount of receivables or payables before any adjustment. Before any what? Adjustment. Simply because we know that the reason why we have receivables is because there were some credit sales which were made. We know credit sales is a taxable income. So payables is, we have payables. You see, payables is the amount of money to be paid to suppliers. This is as a result of credit purchases. Credit purchases, we also know in tax, is a taxable expense. Is a taxable what? Expense. Okay, so let's go through that particular point and you see what you're told. We are told receivables have a carrying amount of 2,000 after making allowance for doubtful debts of 80 million and exchange gain of 160 million, which is unrealized. Unrealized exchange gain, this one is treated as an asset. Being an asset, in arriving at that figure of 2,000, it was added. But the allowance for doubtful debt of 80, in arriving at that figure of 20, that is 2,000, it was deducted. We don't even need to go to the last point. So we just need to know the figure for 2,000 is the net, because that is after making adjustment. It's after making what? The adjustment. After making what? The adjustment. So therefore, receivables, we have receivables here. Receivables here. And basically we are saying receivables and payables. The carrying amount is the net. Is the net. 2,000, which you're given there, is the net amount. Is the net amount of receivables after making adjustment for allowance for doubtful debt and the exchange gain. So, but how do we get the tax base? Tax base is basically the gross amount, the original value. The original value. So basically, in arriving at this, we have said two things were done. The amount of 80, which is the allowance for doubtful debt. Nowadays, we don't talk of allowance for doubtful debt. Maybe this is something you will come across in other subjects. Nowadays, we don't talk of allowance for doubtful debt, but we talk of expected credit losses. Equally, we don't talk of budget written off. Nowadays, we talk of credit losses. Yes, so those are maybe some terms you need to be aware of. You are likely to come across that in other subjects. For example, you'll do BDA after this, you'll be coming across these terms, credit losses. Credit losses, these are budget written off. This what was previously known as the budget written off. So nowadays, equally, we don't talk of allowance for doubtful debt. Allowance for doubtful debt, we talk of expected credit losses. Expected credit what? Losses. So therefore, in arriving at this value of 2,000, two things have been done. This allowance for doubtful debt has been deducted, and then we have unrealized foreign exchange gain of 160. And remember, I've said that this is unrealized exchange gain. Unrealized exchange gain, this one is an asset. So meaning, in arriving at this value, it was added. This one was added, but this one was deducted. So how do we arrive at the original value for receivables? How do we arrive at the original value? Take into account this, the net. So to get the original value, we will add back 80, and then we less 60, which has already 160, which has already been deducted. Which has already been what? Deducted like that. Sasa? Yes. And that will give us what? This will give us what? This will give us what? I've said we take 2,000, we add back 80, which was deducted, and we less 160, which was added. That will give us what? That will give us 1920. 1920. So we get the difference between the two. Is it 80? Is it 80? Yes. It is 80. And because it's a positive, that one is a taxable temporary difference. Is a taxable temporary difference. Is a taxable temporary difference. So let's move to the other point, number 4. Number 4, we have the trade and other payables. And even before we go through that point, it is important for you to note that what we have in note 1 here is basically an asset. Note number 2, we have an asset. Number 3, we have an asset. This one is still an asset. But basically what we have in note number 5, that one is a liability. Sasa, yes, I'll be able to explain why we need to know that this is a liability. Now, what are we told in note 4? We are told trade and other payables are stated at 36. Stated where? In the statement of financial position. So, if they are stated in the statement of financial position at 36, that is the carrying amount after making provision for a discount of 40 million. So this amount is the net. An amount of 40 million has already been deducted. Remember who we have said here? The carrying amount of payable is the net. So this one is net. But what is the tax base? The gross. So to get the gross, we will take this, we'll add back what has already been deducted. What has been deducted is 40. So we add back 40, and that will give us what? 36 what? 40. So we add back 40. Now, number 2, because by the end of the day, we will get the net amount of temporary difference here, the net amount of the temporary difference. Anytime you're recording a liability here, like this being a liability, you record both figures as negatives. You record both figures as what? As negatives, because it is a liability. If you check on all these other items, they are assets. And therefore, how do we compute the temporary difference here? To compute the temporary difference, we will take this, which is negative 36,600 minus this, minus negative 3640. So I hope you can see what you have done. Minus this one, negative 36, minus this one, which is negative 3640. So we will have negative 36. Negative and a negative is a positive 3640. And basically this will give us what? This will give us 40, which is basically a positive. Being a positive, that is a taxable temporary difference. Is a taxable temporary what? Difference. So we are done with that. Let's move to point number 5. And point number 5, we are given the property, plant, and equipment. So for the PP, this one is quite simple. A PP, because the carrying amount, this one is equal to net book value. This one is equal to the net book value. The cost minus accumulated depreciation, whereas tax base is equal to written down value. So this one is equal to the cost minus accumulated depreciation. This one is equal to the cost minus accumulated investment deduction. Minus accumulated investment deduction. Investment deduction, remember, they are also known as capital allowances. They are also known as capital allowances. Sasa, yes. So what are we told in note number 5? We are told property, plant, and equipment has a carrying amount of 48 and a tax base of 4,000. So we have the carrying amount 48 and the tax base of what? Of 4,000. And then you're told in the last sentence, some landed buildings were revalued upward by 2,000 during the year. So I'll be able to explain how we deal with that revaluation gain, but we don't capture it here. What we capture here is the carrying amount and the tax base. I'll be able to explain how we use that word. We use that revaluation gain. Sasa, yes, but let's first of all get the difference. This minus that will give us positive 800, which is a taxable temporary difference. And then finally, note number 6. Note number 6, we have intangible assets. Intangible assets. So intangible assets, basically, these are those assets which arises from the costs which are incurred by the company, but those costs are capitalized. What do you mean by a cost being capitalized? So these are those costs which are incurred by the company, but the costs are not taken to the income statement as an expense for the current year. Rather, what happens is that those expenses are treated as an asset, and then they should be amortized over a given period of a number of years. Let me give a good example. So some of these companies which operate in Kenya, like the telecommunication companies, like maybe Airtel, Safaricom, for them to be allowed to operate in Kenya by the communication authority, usually they're required to pay a license for like 3 years or even 5 years. So you may see a company like Safaricom paying like 1 billion, or maybe that is an example I'm giving. So these are licensed to operate in Kenya for the next 5 years. Now, once that amount of money is paid, 1 billion, should that be recognized in the income statement when it is paid? Automatically, no, because now this is an expense for the next 5 years. Is a license which is paid. It will help that company. It will enable that company to operate in Kenya for the next 5 years. So automatically, once that cost is incurred, you have to capitalize it. You recognize it as an asset, and then you do what? You amortize it. You do what? You amortize it. That is in accordance with the IS what? IS 38. Yes. So how do we determine the carrying amount and the tax base of such intangible assets? Intangible assets. So the carrying amount, this one is equal to the cost minus accumulated amortization. How much amount has been written off so far? But now the tax base, this is equal to amount allowable for tax purpose, in the future. For tax purpose in what? In the future. Amount allowable for tax purpose in what? In the future. So how much amount would be treated as allowable expense in the future? In most of the questions you will come across in relation to this intangible asset, you'll be told a company, for example, paid a trade license and the company incurred a cost of maybe 5 million, and the full amount was treated as allowable expense during the current year. If the full amount was allowed for tax, it was treated as allowable expense during the current year, it automatically means that that amount will not be treated again as allowable expense in the future. If you have a business, you have incurred an expense of 5 million during the current year, and the taxman allows you to treat that as allowable expense during the current year, it is obvious that you can't treat that expense again in the future as allowable expense. It means that the amount allowable for tax purpose in relation to that expense in the future is always zero. Is always what? Zero. Because by treating that amount as allowable expense again in the future, you are reducing the tax payable to the government. The taxman will not be able to allow that. The taxman will not do what? The taxman will not allow that. Will not do what? Allow that. So therefore, that's basically what you need to know. So we are told the intangible assets consisting of trade licenses amortized over 5 years had a carrying amount of 240. We are given the carrying amount. And then you're told this was allowed for tax purpose in full 2 years ago. So what will be the what will be the tax base here? That these licenses were which were paid for, the full amount was treated as allowable expense 2 years back. 2 years back. What would be the tax base? Amount allowable for tax purpose in the future. How much amount would be treated as allowable expense in the future? How much amount would be treated as allowable expense in the future? Yes, automatically here we have said is zero. Remember, I would have explained, this one will be zero. The full amount has already been treated as allowable expense. There is no way the taxman will allow you to treat that expense again in the future as allowable what? Expense. So the tax base here is zero. Is what? Zero. So we get the difference here, which is 240, and that is taxable temporary what? Difference. Taxable temporary difference. And I think we are done. We are done. So because number 7, what you're given there is the tax rate. So what we need to do here, we add all this, we get the net amount. Whatever is a negative, you take it as a negative. Whatever is a positive, you take it as a positive. So let's add all that. Let's add all that. Let's add all that. We have negative 8, which is basically negative 16. Yes, I'm told this one will give us 1064. 1064. And that being a positive, this one is known as the net taxable temporary difference. The net taxable temporary difference. Net taxable temporary difference. Net taxable temporary difference. And basically, this is what was required in Roman 1 of that question. This is basically what was being required. This is what was required there. And then the marks which were allocated for doing that were 8 marks, computing the relevant temporary differences. And basically what was marked there is a final answer here. This one. This is what will earn you the marks. Not this, not that. But the final what? The final answer there. Now, let's go to Roman 2, and basically what you're required to do is we make the relevant or the journal entries to record the changes in the deferred tax liability. Now, for you to be able to understand those journal entries, what I want us we prepare something called the deferred tax account, and then we make those journal entries. We make those journal entries because by first of all preparing the deferred tax account, you'll be in a position to understand what you're doing. Or basically, you'll be in a position to understand the double entries for those items which cost the deferred tax liability to change. So we first of all prepare the deferred tax liability. The deferred, actually you can just refer to this as the deferred tax account. We just refer to it as the deferred tax account. Deferred tax account, the deferred tax account. Now, in this deferred tax account, we always start by recording the deferred tax liability at the start of the year. Remember, this is a ledger account. This is the credit side. This is basically the debit side. This is the debit side. And we start by recording what you're given in Roman 1. Let's go back, not Roman 1, rather, paragraph 1. In paragraph 1 of that question, paragraph 1, we are told Mafuta Limited had a deferred tax liability at the start of the year of 40 million. 40 million. So in that case, we are told our company at the start of the year had a deferred tax liability. So that being a deferred tax liability, the opening balance will be a credit balance because that is a liability. All the liabilities we know, they have a credit opening balance. So the deferred tax liability at the start was 400 million. Yes, 400 million, not 40. 400 million. And then we also know that at the end of the year, we have this one.